Hello, this is Salil Zaveri. Thank you for tuning in to this segment. In this particular segment, I'm going to give a number of tips of do's and don'ts that are insurance related. The first being having the adequate amount of disability income insurance. Most people buy life insurance, auto insurance, home insurance, health insurance, but they don't address a very important issue, which is disability income insurance. That is a very, very important benefit to have. If any of us hurt ourselves, whether it's through sickness or accident, Social Security would give us benefits, provided we are totally unable to do anything. If you're able to do something else, for example, let's use a dentist, and your situation may be different and we can address it one-on-one. But a dentist may have gone for a weekend trip and having fallen maybe on some rock or on a sporting event could have injured and broken their hand. And it could have been temporary or it could be permanent. Sometimes an injury becomes permanent. If this dentist broke his thumb so badly that he can never hold his dental tools again, that's the end of his dental career. What would happen? This dentist would obviously be able to collect from Social Security temporarily, very small benefits. The coverage is very little from the government. If he's earning, let's say, just $100,000, and dentists can earn less, they can earn way more, but I'm going to use only $100,000 as an example. This dentist may collect minimal benefits at best from Social Security. But if he had a private policy, a disability income policy from a private carrier, this dentist would be able to collect approximately $60,000 tax-free per year. And depending on how the policy is structured, would be able to collect not only $60,000, but each year that amount would be increased based on cost of living increases. So maybe next year $65,000, then $70,000, then maybe $75,000, and so on, to at least keep up with cost of living. Again, if the policy is structured correctly, the dentist can then shift from being a dentist, which he cannot do anymore because of the broken permanent loss of thumb, and maybe go teach dentistry, or maybe become an entrepreneur, or start a different kind of profession altogether. And income would resume again from the other occupation. But if the policy was structured correctly, they would continue, the dentist would continue to receive that disability income benefit on and on and on to age 65. It would not stop, even if the income was replaced. So it's important to know to have disability income coverage because things happen. Car accidents can be permanent, where the disability could be permanent. If it's fatal, then that's a different story. But if you're disabled, it's a living death not to be able to have an income. And if you're unable to perform your own profession, but able to perform some other profession, Social Security won't pay you. And even if they do pay you, the amount is very little. So it's important to have a specialist guide you in disability income insurance to get the maximum benefit. So if you're earning 100, you want to get close to the 100 as possible. To receive it tax-free, it's important not to deduct the premiums of a disability income policy that you may own privately, because if you deduct the premium, later when the benefits are received, that $60,000, IRS will tax it. So that would be like a double loss. Not only don't you get the $100,000, you only get $60,000, but then you get taxed on the $60,000, so you might end up netting $35,000 or $40,000. So don't do that. Don't deduct the premiums of disability income. That's an important thing to remember. A, have enough coverage, and B, don't deduct the premiums. And make sure the policy is structured correctly so it's indexed to get the maximum years of coverage with the cost of living protection. Make sure you combine companies. Don't get one company, because if one company denies the claim, you could end up not collecting anything. By stacking policies, having multiple carriers involved in that coverage, you would end up having multiple companies that would come through for you, and maybe one won't. So we will guide you. We're independent brokers. Don't deal with an agent who represents one company. Also, the limits may be very low as a single carrier. We can combine companies and stack coverages so that you can have maximum percentage of coverage done correctly. In this particular tip, I'd like to address life insurance. It's important not to get the wrong plan. It's also important not to get the wrong amount. Sometimes people tell me, Salil, I want whole life insurance because I get cash value. And give me a certain amount of whole life insurance and no term insurance. And I would say to that person, let's reassess. I get a higher commission when I sell whole life over term. And there's many other kinds of plans. I'm just using this as an example of two particular products. Say that you, not that you are, but let's say that you are 30 years old, newly married, and you have now possibly a child. You might need coverage of $1 million or $2 million because once you're gone, that income is gone. Your wife may have to go to work, but then who's going to watch the baby? So perhaps you want to give your wife the option to stay home with the baby. And the only way to do that is to keep your income coming. So if you are earning $100,000 a year and you want to continue the $100,000 a year, you have to make sure that there's enough coverage so that they can live on interest and deplete as little of the principal as possible. So if, let's say, using $2 million of coverage is an appropriate amount, we'd have to do more calculations than using these rough numbers. But how would you be able to afford a $2 million whole life policy unless you have a great job? If you do, wonderful. Buy a permanent plan, get cash value. It could be whole life, it could be universal life, it could be indexed universal life, it could be a number of products. And term may not be an avenue for you to choose. But if you have a limited budget, now you have to structure things together. You may be able to buy $2 million of term, but very little of whole life. So the choice would be maybe buy $250,000 of whole life or buy $2 million a term. I would say buy the $2 million a term. Of course, I make a bigger commission if I sell you the whole life, and that's what a lot of agents are doing. They're telling clients, buy the whole life. Term is not good. I would say buy what's appropriate. So don't choose a product based on what it does for you 30 years from now. Think about what it does for you now. 30 years from now, you and your wife can hopefully deal with retirement benefits together, and there'll be other dollars to supplement. Today, if you pass away prematurely, you can't undo that. It's important to have the right amount of coverage all the time, and then worry about retirement. In this particular piece, I would like to address choosing the right company. It's important to choose not just one, but several. Make sure your coverage is not with a single company, because that single company denies your family the claim, you're out a lot of dollars. So to spread the risk, make sure you're covered by several carriers for the same coverage that you wanted rather than with one carrier. Same as having bank accounts in multiple places to utilize the FDIC protection. You want to do the same thing with life insurance or disability insurance. Make sure that we spread the risk by having multiple companies. On top of that, let's choose companies that have high ratings. There are many companies that have high ratings. They're likely to be around, but ratings change. Don't just buy it and stagnate on that decision. Keep reevaluating what you bought. We help you. We help you review to make sure those ratings of those companies are still solid. There were companies such as Equitable Life, a large company, went out of business. AXA purchased them. Now, all of a sudden, the value changed. What Equitable had promised and what AXA's promising is two different stories. Good company, AXA. Equitable was a good company, but they faced circumstances. Things happen to companies. Don't just buy it and forget it. Let's revisit the ratings all the time. Let's make sure that these carriers are still solvent. If they're getting weaker, let's make sure that we readjust the portfolio, just like a stock that you might hold. In this, I would like to address misstatements. It's important to understand that everything needs to be disclosed. If you have an occasional cigarette or an occasional cigar, or you've seen certain doctors that you don't disclose on an application, it can be used against you down the road. Many agents conveniently help you cover things up because they want to see the policy get approved. And then they want to deliver it to you, and you think you got a great deal because you might not have mentioned something that might have been a surcharge. By doing that, the risk you take is at claim, they may deny it. Companies will issue a policy today because they're quick to get their production under their belt as well. And the agent wants to get it issued because they want to get their commission. But down the road, the claims department has a completely different attitude. They're going to look at that claim and they're going to uncover things. They're going to go back in the medical history and they're going to find doctors you may not have disclosed. They may find out from your colleagues that you smoked. There might be some Facebook photos of you holding a cigar. There could be all kinds of things that can undo what you had said on your application or not said. So it's important to disclose everything because someday things come out and you want to make sure that the claim cannot be denied. Saving a few dollars in premium today could affect millions of dollars of benefits to your family, and that's not worth the risk. It's more important to tell me what's going on with you completely, and then we can choose a carrier that doesn't look at that as a detriment. There are carriers out there that will accept certain things. They'll say, fine, we don't have a problem with that. So let's disclose it, let's get the right price, and then let's say it's even a surcharge. Suppose you smoke today, the occasional cigarette is smoking, so let's not say you don't smoke, but let's say you then quit smoking. Let's go back and let's re-underwrite. Let's go to the company and say, hey, my client stopped smoking, give us a lower price. So that's an incentive for you to give up smoking. It's an incentive for you to not say the wrong thing and have peace of mind when you go to bed at night, to know you have the full coverage, that your family will get paid. Diversify the coverage with multiple companies to make sure if one company says, no, you lied, the other company might say, okay. So diversification and complete disclosure. Let's say everything. And then when they issue the policy, you know you have a real policy, you know what the real premium is, and we can go and re-underwrite to get a better deal down the road. And as I said, some companies may even forgive that. They may say, it's okay with us, we don't mind that. So let's disclose everything. When you apply for an insurance policy, the underwriting process, if handled correctly, benefits you. Typically, if you're talking to a single agent of a single company, they will do an application for that company. So all the information you give is sent up to that company, and whatever they find negative, they're going to put on what they call the Medical Information Bureau, MIB. So then you'll have an MIB record of the negative they found. Any other company you go to in the future will see that record, and they'll all hold that against you. It's like a credit report. So it's better not to do a single application with a single company. First and foremost, it's better to do a preliminary application, which we as independent brokers can do. We can take a generic application, take all your information, get the medical records, have our internal underwriting department look at that, and tell us whether or not you would qualify for a good price. If we feel that there's something detrimental in your medical history, we can show it to you. We can say, look, this is what's going on and you're going to get hurt on the price. You can go back to your doctor and say, hey, doc, why'd you write that in my notes? It's not true. Sometimes doctors over-exaggerate to protect themselves. For example, if you have a slight ailment, they might say, I've advised the client to take these extreme measures just to cover themselves. Now, that statement would scare an underwriter at an insurance company, and they might jack up your rates. When we see that up front, rather than just sending it up blindly to an insurance company with your name, it will end up on the MIB records, that negative statement. We would see that and we would say, let's not send it up that way. Go back to your doctor and say, doc, what are you concerned about? And if the doc says, oh yeah, you're fine now, everything is good. Okay, fine, doc, please make a note that I'm fine now. You don't have a concern. Now the underwriter looks at that statement in conjunction with what was written before, and things are normalized. So it's important for us to do two things. know what the underwriters are going to see first. So by taking this generic application with you, we'll be able to see what the company might see. And then we can work with you and your doctors to fix what needs to be fixed. Get on the right medication, get under the right treatment plan, get bad notes adjusted, not removed, because, the doctor's not going to wipe something out that's true, but it's good for us to know how to counter that. And if we make a case that balances the negatives, the underwriters at the insurance company will look at it more favorably. Also, we want to go to all the carriers rather than go to one, because we want them bidding against each other. We want every carrier to come back to us and say, we would give this particular client this rating. And the rating number dictates the price. So it's almost like a credit score. So we want to make sure that we compare offers and then talk to you about those offers. Then look at the ratings of those companies to see if it's worthy of taking that company, and then spreading the risk. Deal with several companies, not one. So that's our underwriting process as opposed to just applying with an agent. I would like to discuss with you conversion privileges. That is applicable when you buy term insurance. So say you started out early in your career and your life and you wanted to get $2 million of coverage and you got all term. Well, it's important down the road, as you may see on your charts of the premiums, that term premiums go up. And at some point, term policies end. They cancel you. They send you a notice in the mail and say you're no longer covered. So you need to know what to do if you want to keep the coverage. So if you go with a carrier that has no conversion privileges and the only thing that can happen is cancel your policy, that may not be something that you want. It's important to understand the conversion privileges company by company, contract by contract. There may be certain companies that say you can exchange from that term policy into a permanent policy, which may be good for you. You may want to do that someday. You may want to extend the length of time using other privileges. So don't just necessarily go with the least expensive term policy. Sometimes a different term policy might make more sense because there are conversion privileges in there that are more valuable to you. And that to be aware of is important before you choose on the price. In this particular segment, I would like to draw your attention to underinsured motorist coverage and uninsured motorist coverage. There's some people you're going to get into an accident with someday. Hopefully you never have one. But if you do, and the other person does not have any insurance, it'll be very difficult for you to collect from that person. To sue them and to wait would be near impossible. It's better to have on your own policy underinsured coverage and uninsured coverage. A lot of companies sometimes neglect to tell you that having the maximum is in your best interest, because most people who call say, hey, I want a low premium, so the agent at the other end on a call center might sell you 100, 300 of underlying coverage, but they may sell you the minimum uninsured coverage, underinsured coverage, just to keep the premium down. Well, it's important to get the maximum uninsured, underinsured coverage, because you are the one that benefits from that coverage if the other party does not have coverage. So if you want more details on that, please show me your policy and I'll show you a comparison of what I mean, or call your own broker or agent and talk about the pricing on uninsured coverage, underinsured coverage, and maximize it. It doesn't cost much. I would also like to alert you about homeowners coverage. It's important to have the correct amount of coverage, replacement cost as we call it. Sometimes when you close on a loan with a bank for a home, the bank might state, for example, if the loan is $500,000, they might say they want $500,000 of coverage. You may not need that. You may need only $400,000 of coverage. And the bank will accept that $400,000, because replacement cost means that the bank will be fully covered for the full amount of the loss they're in it for, because land does not burn. So if the bank is concerned about the amount of coverage, talk to me, talk to your agent, talk to your broker, and work on a replacement cost value. And ask the bank to accept that. because that covers you for 100%. You're never going to get more dollars than what the home is worth. So why pay more than you have to? The insurance company will be happy to take the higher premium, 20, 30, 40% extra, because the bank stated they wanted it, but the bank also accepts the accurate amount. So go with the accurate amount, not a fictitious number. It's important to have umbrella insurance. What umbrella insurance does is it covers you for a higher amount of liability. Let's use an example. Say you're involved in a car accident and you have 100, 300 coverage, underlying coverage. And let's say there's 3 people in the car you just collided with, and all 3 of them sue you for $500,000 each. Now, and let's say the court awards them that, $1.5 million. Your insurance company is going to pay a maximum of $100,000 per person, $300,000 maximum. So now the other $400,000 that each of them are owed is going to come from a personal lien on your properties and income. So you're short $1.2 million. The court awarded $1.5 million to 3 people, but the insurance company is going to pay a total of $300,000. And you will be working for the rest of your life to fulfill those claims, which is not fair to you. But if you have an umbrella policy, say for $2 million, that $2 million comes over and above the $300,000. So it's important to have that umbrella coverage, which goes not only above your auto insurance liability, but it goes over your homeowner's liability. Because you're entertaining at home and someone gets hurt, unfortunate things happen, they're going to sue. And if they sue and they're awarded $2 million, again, your homeowners may pay only $100,000 liability, and you're at $1.9 million out of your own pocket. So please price out an umbrella policy. If you need help, we can help you.